we are going to do an episode today about market volatility and what it reveals about your investment portfolio. And this is awesome because this is not something I would talk to clients about, but it's something that I think that they should consider and think about and maybe get some answers to. So I'm thrilled to dive in today.
Welcome to the Law Firm Owner Podcast, powered by Velocity Work. This is the work that creates velocity.
Welcome back to the Law Firm Owner Podcast. I am so thrilled to be here again with Megan Robin. Thank you, Megan, for coming back.
Yeah, thanks for having me. I'm excited.
Me too. For listeners or viewers seeing Megan for the first time, I highly encourage that you go listen to her previous episodes. I think we have 4 previous episodes with you at this point. We have you back today to talk about another topic that I think listeners and viewers will find very interesting. If you want to give maybe a sentence or two just about who you are and what you do, we'll kick it off.
I am Megan. I am a tax attorney. I help law firm owners design their financial and tax strategies for their personal and business lives.
We are going to do an episode today about market volatility and what it reveals about your investment portfolio. So recently, we've seen some market volatility and some geopolitical tension. And when markets move the way that they've been moving, investors tend to get nervous. People tend to get nervous. And so from your perspective, how should people think in moments like this?
Yeah, so in times like these, when there's economic uncertainty, it can expose problems that were already existing in your portfolio that you may not have seen because we've been in a bull market for a really long time. And so in bull markets, the stocks are going up, everyone's making money, there's no reason for concern. And a lot of people think if I'm making money, everything's fine, there's nothing to worry about. However, then, when we see market uncertainty, investors often look a little more closely at their portfolios and start wondering, wow, what are those fees costing me? Why am I paying so much in taxes and dividends and capital gain taxes in this portfolio? It really is a good moment to check in and make sure your portfolio is actually solid and not just masking deeper problems.
Great advice. People tend to set it and forget it.
So no one is immune from the ups and downs of the market. Portfolios do go up and down. However, what bull markets can hide is high fees, inefficient portfolio allocations, tax drag, so assets in taxable accounts that probably shouldn't be there. Those are all things that can be buried underneath positive returns. These become a lot more noticeable when the market becomes more volatile because you still pay taxes every single year, whether the market is doing great or not. If you're having stocks that are kicking off taxable dividends that are annually taxed or interest and things like that.
So when you look at a client's investment portfolio, what are you looking at?
So I'm not looking at the individual investments per se. I'm not an investment advisor. So I also don't have a crystal ball. I don't know if, Ford stock is going to double next year. I leave all of that work to investment advisors. I'm looking at whether the portfolio is tax efficient. Two investors can have very similar portfolios, but if they're holding assets in different ways or not tax efficient ways, then their after tax returns can be very different. So what we want to look at is not just your portfolio returns, how much of that are you keeping after the IRS takes their share?
Okay, what are some real tax inefficiencies you see when you're looking at a new client's portfolio?
There are a lot of different ones, but there's one I want to talk about because I think it's very easy to understand and pretty relatable. One thing I see pretty commonly is high dividend paying stocks in taxable brokerage accounts. So a taxable brokerage account is not a retirement account. So anything that occurs in that account gets taxed currently. It's not deferred. And so what I see is I'm not against dividend paying stocks. I actually really like them in the right scenarios. A lot of dividend paying companies are very mature, financially stable companies. They can be an excellent part of a portfolio. However, what the issue here is what is the investor's goal and what is the timing? So for example, if you're in your peak income earning years, so your law firm is booming, you're making a ton of money, and then you come to me and I see a ton of dividend paying stocks in your taxable brokerage, that means you're likely in a higher income bracket, meaning you're paying 20% capital gains rates and you're paying those every year because it's a taxable brokerage account and you don't need the money. You're not relying on that for income. So that would be not tax optimized, in my opinion, versus if someone came to me and they had retired and they had a large portfolio, they'd grown it over years, and they were using the intentionally purchasing dividend income producing stocks because they wanted to live off of that dividend income. And it's a really tax efficient way to pull money out of your brokerage accounts without having to sell anything or do a rebalancing or any liquefy anything. It's a great way to pull money and live off of that dividend income. So it's two completely different scenarios. One, not tax optimized. The other, very tax optimized because you're getting that 20% rate. You're living off of that income. So it really depends what's going on. And so I'm looking at, where is this individual? What income bracket are they in? Do they want this kind of income, or would this stock be better held in one of their retirement accounts instead, where it can generate, income, but that won't be taxed until they pull it out. So it's being thoughtful and intentional with your investments.
You mentioned tax drag earlier. Can you explain that?
So tax drag is kind of a casual phrase used to talk about the impact of taxes on your portfolio. So if you're pulling money out and getting taxed, so maybe you have capital gains or dividend income or something like that, interest income, a lot of people will reinvest that income and just kind of keep it in the portfolio. But before it gets reinvested, it gets a slice taken off of it by the IRS. And so that's a smaller portion that can compound and grow over time in your portfolio. And so we want to reduce that tax drag so that a larger portion can grow. You want your earnings to be earning earnings, and you want your portfolio to be growing at a more rapid rate. And so we want to reduce tax drag and reduce unnecessary fees to make it so that you have the largest possible portfolio that can grow over time.
How does tax drag affect law firm owners specifically?
A lot of law firm owners are higher income. Attorneys in general can be higher income. And that means they're subject to higher capital gains rates up to 20% and higher marginal tax rates all the way up to 37%. A common misconception about portfolio income, such as stocks and bond portfolios, is people assume that the entire thing is going to be subject to capital gains rates. They think, oh, investments, capital gains, 20%. But that's not actually true. Different pieces of your investment portfolio are taxed differently. So, to give an example and kind of provide context, stocks, for example, when you buy and sell stocks, those are taxed at capital gains rates. Stocks are equity, so you own a little piece of a business. I have a 7-year-old now son, and he knows what I do. He knows I'm a tax attorney, and he was asking me about this, like, what is investing? What is a stock? He hears me talk about things. And it was funny because we were in Target shopping, and he said, "Hey, mom, do we own this company?" Because he knows I was explaining, I'm a huge fan of passive index funds, big, broad based total market indexes. So you own a little bit of everything. I tell him, yes, we own a little bit of Target. And so we're shopping, and he looks very kind of into this idea. And we get to the checkout stand, and he says, "Well, mom, why do we have to pay? We own this company."
That's awesome.
Right, just so funny, and it highlighted for me, when thinking about these topics, the difference between ownership and debt. So people understand, or most people understand, that stock is ownership, even if the part you own is tiny, whereas bonds is debt. So a bond is you giving a loan to a company. And when you do that, they pay you interest for the term of the loan. So say it's 5 years. Over the period of 5 years, you'll earn interest every year that they have your money. And at the end of the term, they return the money to you, pay you back, essentially. I think the reason people get confused by bonds is a lot of people hold these in bond funds, so bond index funds, etc. But the interest that you earn along the way from a bond is not taxed at capital gains rates. It's taxed at ordinary income rates, which are much higher, so up to that 37%. And the confusion, I think, comes from the fact that when you hold a bond in a fund, if that bond becomes worth more later and there's a gain there, then the increase in value of that bond will be taxed at capital gains rates. But the interest that you're getting paid along the way is still ordinary income. Would it be helpful to explain kind of why a bond might be worth more later or less later?
Yes.
Okay.
Yes.
So what happens is, say interest rates today are 5% and I borrow or I loan money to a company at the rate of 5%. That bond is static, and the whole time during that 5-year period, I will get paid at that. But say next year, bonds are paying 10%. That's a lot more. I would rather get paid 10% interest on the loan that I had as opposed to 5. I'm getting half of what my neighbor is getting. So what happens is maybe I'm frustrated with this. I want to just offload this bond to sell it on the secondary market. No one's going to pay very much for my bond that only pays 5% because they can go out there and buy one for that's paying 10%. And so that's a moment where you would have a loss. If we flipped that and I had an old school bond that still paid 10 and interest rates are tanking, then I could sell my bond that still pays 10% at least for a few more years at a premium because people say, oh, wow, you can't get bonds like this anymore. Now they only pay 2 or 3%. And so that's where that conversation of capital gains or capital losses could come in with bonds. But the general just interest that the company's paying you for the benefit of borrowing the money, kind of like a mortgage, you pay interest on that. That regular interest that is coming into your account is taxed at ordinary income rates. The same goes for a lot of those interest paying bank sweep accounts. So I don't know if you've ever seen in portfolio, if you do a trade or something and money will just kind of land or settle in these sweep accounts. Those are ordinary income, a lot of money market funds, high interest savings accounts. So there's a lot of times where in your investment portfolio, you will have quite a few things that are being taxed at ordinary income rates. So 37, not 20. So we want to think about the types of investments that you have in taxable brokerages and make sure they're in the right places to be as tax efficient as possible.
What are the biggest issues that you see in non-taxable accounts, like the retirement accounts?
Yeah. So the biggest thing there, obviously, it's not a tax issue because those are not taxed until you take it out, or if it's a Roth, never. The issue is unnecessary complexity. So the first reason that this can happen is because you'll see this with people who've moved jobs a lot of times. So they'll have a lot of different retirement accounts with different employers. Usually, employer sponsored retirement accounts have a very limited suite of options of funds that you can invest in. So people are a little hemmed in. And so they're picking things that maybe aren't optimal. And then they're stacking a lot of these together, and it doesn't make sense as a whole. The second is the solution that people often will have is, oh, we'll roll it all together and with one financial advisor under their management. But the second problem that I see is that sometimes doesn't solve the problem because a lot of financial advisors, I'm not sure why they do this. I don't know if it's to justify their fees or to make it look too hard for you to understand and make you feel like you need them. But what they'll do is they'll have 15 or 20 funds when 2 or 3 would do. And so I'll see multiple funds where they're all holding the same major companies. So it's, an S&P 500 fund and then one that holds just Tesla and Apple and a couple electronic companies, but those are also already in the S&P. And so it's target date retirement fund or a broad total market index fund would do the same job as some of these very complicated portfolios that have a lot of overlapping investments. And when I see that, I'll flag it. I don't give people investment advice, but I'll tell them, this is what I'm seeing. And you want to make sure that you're not paying for unnecessary complexity here. So, a lot of times, especially with managed funds, there's higher expense ratios. You're paying AUM fees. If they're trading in and out, there can be trading commissions. And so, after all of that, that can really whittle down your account. And so that can be an issue we see that goes unnoticed during bull markets, but in market volatility, people start asking questions like, why am I still paying this much when my portfolio is tanking and I still owe all of these trading commissions and these AUM fees and all of that? That's kind of when these things people get a little frustrated, I think, with the complexity. So we have to make sure that complexity is warranted. There are moments in time that it makes sense. Maybe an investor has specific goals. So I worked with one individual who's very socially conscious and had a lot of really specific values. So he didn't want to invest in companies that did certain actions or didn't support people with certain backgrounds or religious beliefs. So it depends what you're trying to do. There's no wrong option. My goal is not to tell people, do this, do that, don't do this, don't work with this person. My goal is to say, understand and do it with intention. So if you want that, then that's something you can build. You just have to understand what the cost is for it, what the pros and cons are, and just have overall transparency.
Yeah, you just help open people's eyes to the truth of different scenarios. What are some questions that investors should ask, listeners, viewers who are investing should ask when reviewing their portfolio from a tax perspective?
So the first is, how tax efficient is your portfolio? You can look at the end of your tax return and look and see how much did I pay in capital gains and dividend taxes? Also, how much am I paying in fees, and how much does my portfolio align with my overall goals? One of the things that I think people can get carried away with, especially now, there's really interesting things going on in the world of investing and trading. There's apps like Robinhood and some of these others that make it really easy to be an amateur investor and do individual stock trades and a lot of almost very advanced trading things that used to be really limited to Wall Street professionals or financial professionals. And now you can open the app and do pretty complex trades that I'm not sure the people doing them always understand. And then a lot of them are gamified too. So it's making it kind of fun, and there'll be confetti and all these different things that
Oh
the
my
app will
gosh.
gamify your trading. And if you have a high or low, I mean, if it's fun for you, then just think of it like a movie ticket and go for it. It is what it is. So I want people to focus on, because someone will say, I just did all these trades and I was doing this individual stock. But what we're looking at is not how much money you made, it's how much you got to keep. So again, as I'm just hitting this home a lot during this podcast, but it's your after tax returns. So maybe you bought, what was it, GameStop? But a lot of times that boring approach with a tax efficient portfolio that you just don't touch and leave to grow over the time, that's the Warren Buffett strategy, and he's done pretty well for himself. So thinking about it that way, kind of the less involved you are, the better sometimes, especially if you're an amateur investor and not a professional.
Okay, so what's the key takeaway for listeners after this episode and the things we talked about?
Don't wait for market volatility or a recession or a crash to take a look at your portfolio. Don't let the bull market or positive returns deter you and make you think that everything's fine. Look under the hood. And then, as we've talked about a lot today, look at your after tax returns to see how you're really doing.
So good, so sensible, so practical. And thank you for coming on to share your wisdom and knowledge with us. If people want to get in touch with you, where do they go?
My website, meganrobin.com, is the best place to find me.
Okay, good deal. Megan, you got to come back more if you're down.
Of course. Thank you so much.
This content is for informational purposes only and does not constitute legal, tax, financial, or investment advice. Before you go, be sure to hit subscribe so you don't miss an episode. And if you'd like to hear more on this topic, let us know in the comments below. Thank you for listening to the Law Firm Owner Podcast. If you're ready to get clearer on your vision, data, and mindset, then head over to velocitywork.com, where you can plug in to quarterly strategic planning with accountability and coaching in between. This is the work that creates velocity.